Good morning, everyone. My name is Michael Naidrich, and I am the Co-CEO of AmeriVet Securities. As always, I am joined by my partner, CFA, all things Fed, liquidity, and rates, Gregory Faranello. Good morning, Greg.
Good morning, Michael.
And now, back for a second time from Bloomberg, our good friend, Ira Jersey. Ira, thank you so much for being so generous with your time as usual.
Hey, thanks very much for having me again.
Well, it's really our pleasure, and thank you so much. We're going to kick right into it. Just because the Fed pauses doesn't mean that we do. So, as always, Greg, I'm going to kick it over to you and let you and Ira have a thoughtful conversation about what's going on here.
Thank you, Michael. I appreciate it, Ira. I think it's your third time back here, but two times, three times, it's always great to have you. And I love getting your thoughts and insights. I thought we'd kick it off. I've got some buckets to talk about. And I think some are probably more relevant than others, but I thought maybe we'd start off with the Fed minutes, coming out of the minutes, what you saw in the minutes, and then obviously the Fed speak since then, which is now sort of leading into this Jackson Hole confab.
Yeah, so I guess first, Greg, the way that we read the minutes was more of the same. The market certainly took the minutes as being a little bit dovish. We actually have a model where we take all the phrases out of the minutes and trying to determine whether it's more hawkish or dovish than the time before. And actually, that model showed that it was the most dovish that we've been in terms of the minutes since about 2021, in a bit over a year. But that being said, it basically highlighted the fact that there's a debate going on at the Fed, which always exists, but to varying degrees, and that is, are we going to hike too much, or are we not going to hike enough? Right. And that's the debate that I think both the markets are having, and obviously they are internally at the Federal Reserve as well. So I do think for right now that what the minutes highlighted was that there is a fear by some people at the Fed that they're going to push us into a recession, but more people are still worried about the inflationary environment and not wanting to go too little, that they make the mistake that the Fed made in the mid 1970s, which was they stopped hiking even though inflation continued to rise, and they had a second inflationary impulse after that. And there is a long institutional memory at the Fed, and there are a lot of historians there. So that's something that's going to be on the back of their minds.
Yeah, but that makes sense. I reread the minutes last night, and to your point, certainly there is a sense of, I think, hesitation, it seems, on the part of some members of the committee about going a little too far, slowing that pace down. With regard to Jackson Hole, I thought, briefly, we can go back, look at 2020. I look at this time frame from COVID all in the same in terms of policy. You look back to 2020, we had the framework change. 2021, still a lot of talk of transitory, even though in the summer of 2021, a lot of global central banks had already made their pivot. What's your perspective, leading from those two time periods leading up to this week?
Well, just about every Jackson Hole we have to pay attention to, because there have been a number of pivots in policy, or at least significant clarifications of the thinking and the framework coming out of the Fed. So, a couple of years ago, we had a framework change that was kind of previewed at the Jackson Hole symposium, and that obviously ultimately became entrenched in the way that we've been thinking about Fed policy since the 2020 Jackson Hole. Last year, there was discussion about the inflation. This year, there's going to be even more discussion about inflation, clearly. But I think that this year might be a little bit different than some of those years where you saw big policy pivots, in that basically it's going to be Chair Powell's way to clarify what he talked about at the last press conference from the July meeting, because the market took what Jay Powell said as relatively dovish. The word saying that at some point in the future we're going to reduce the pace of interest rate hikes. I mean, most of us knew that they were going to do that at some point, but the market took it to mean that they were becoming more dovish. And so I think that this week, it's really really an opportunity for Chair Powell to clarify that, hey, we're not more dovish. We're just shifting from hiking at 75 basis point clips to something a little bit slower.
Yeah, it's certainly going to be an interesting week. I agree with you. I think it's expeditious has become maybe less expeditious, but 50 basis points not too long ago was an outsized move. So drilling down this week, I mean, what's your feeling? What's your gut in terms of this week with the chairman? We know we have this 50 versus 75 going on. Seems like the bigger picture, at least to me, and I think investors, where does this Fed end? Where does terminal ultimately get to? They're talking about higher for longer. What do you see as potentially some of the bigger themes for Friday?
Yes, so I think that Chair Powell is going to reinforce what Mary Daly and what James Bullard and a number of other members of the FOMC have said, and that's that we're going to be hiking into 2023, right? So the fact is that the market's finally starting to get that hint a little bit. We had been pricing for the Fed to basically stop at the end of 2022 and then be on hold only for 3 or 4 months into 2020 into 2023, and I don't think that's something that the Fed wants, right? The Fed at this point, and this is the reason for them to kind of hike at a slower pace, maybe 50 basis points September and then 25 basis points every meeting thereafter, is it will allow them to calibrate to what the market conditions are and how quickly inflation starts to come down. Because, and I think this is something that Chair Powell will note, that, okay, well, it's a good sign that, yes, inflation is coming down. We still have core inflation measures that are continuing to climb in many sectors. So when you look at services sectors, for example, and we look very closely at service spending ex shelter, because that's tends to be a very sticky part of inflation, and that's still rising. In fact, that's still making new highs and continues to climb. So that suggests to us that even if we have a stabilization in energy prices in the U.S., that you're still going to have 4.5–5% inflation on a year-on-year basis this time next year, and that's not an environment that the Fed wants to see. So the idea that they're going to stop at 3.5%, I think, is starting to be priced out of the market. I mean, we're currently pricing for 3.75%, which of course they'll never be at 3.75%. So we're actually pricing for either 3.75% or 4% on the upper bound, which is kind of what most economists look at these days as to where the rate's going to be. So Chair Powell really has the opportunity to solidify what the Fed's forward guidance is. Even though they're data dependent, that's fine. They're always data dependent at some level. The forward guidance is, look, here's our triggers. And the fact is that our real trigger is, yes, headline inflation, but importantly, we want to see inflation in aggregate in just about every sector start to at least stabilize, if not start to roll over. And they're not even close to that yet. So I think he has to kind of hit home to the markets that we're not done fighting inflation quite yet.
I agree. I thought it was interesting on Friday. I thought San Francisco Fed President Daly, I thought her comments were interesting, right? She talked about neutral being at 3%. And I thought Richmond Fed President Barkin on Friday saying, look, we're going to do whatever it takes to get inflation back to 2%, even if it means a recession. So, you wonder if they're laying the table for a lot of what you're saying in terms of Friday, which is, we need to continue to fight the issue at hand, which is certainly inflation. And I think the market seems to be skewing that way, right? I mean, we're certainly reflattening a little bit, reinverting, and short end rates have repriced, and risk is repricing a little bit. What do you think? What do you think about September? I mean, we're sort of going back and forth, 50, 75. It seems like now we're skewing a little bit more 75, but everything that we're hearing from the minutes, from the Fed speak, the data that we've had, what's your thought at this point? And I know a month away is still a lifetime.
Yeah. And we get a whole nother month's worth of data, right? So this is an unusual period where we have 8 weeks between Fed meetings, where we get 2 full months instead of a month and a half's worth of data. And Friday before Powell's speech, we actually get the July PCE data, right? So we get the another read on inflation, another type of read on inflation. And importantly, from that, you get the consumption numbers, right? So the personal income and spending numbers are something that we obviously look very closely at, because the fact that incomes have been rising so rapidly that is allowing for inflation to be more persistent. And the only real way to get around a wage price spiral, which is what you're starting to see, actually, we are already seeing it. I can't say starting, we have been seeing it, is for a recession, right? So when you have Barkin and other members of the Fed talking about significant slowdown, soft landing, look, a soft landing could be a mild recession, right? A soft landing, like we've done it once basically in the post-war period, where the Fed's hiked interest rates and you haven't had a recession after hiking rates. And in 1994, I got to remember it because it was very early in my career. It felt like a recession, even though technically we never went into a recession. It certainly felt like one. So having a very significant slowdown that raises the unemployment rate, that downshifts wages significantly, is something that's going to be required in order to get those services wages I was talking about before and service sector prices to stabilize. Is going to take a very serious slowdown in the economy. And the idea of a soft landing is hard to fathom in an environment where the Fed is probably going to have to hike more than they want to in order to get inflation down.
Yeah, interesting. It'll be interesting to see if Chair Powell talks about the pain in the economy along with what they need to do to fight inflation. We've gone from soft to softish to now more and more, I think, vocal talk about recession. So that trade-off, I think, will be interesting on Friday. Ira, this has been great. Like I said to start, I always appreciate your insights and your views on the market. I read your research along with Angelo and your team, and we really, really appreciate it. And we really appreciate your time today in front of a very, very important week. So with that, Mike, I'm going to turn it back to you if it's okay.
Absolutely, Greg. And I just want to echo your thoughts. Thank you to Ira. Again, just being completely generous with his time and his thoughts for us. And Greg, thank you to you. You know how much I love doing this. So I'm glad we didn't pause. And for all of our clients, anyone needs to get on the phone with Greg or Zoom, he's fully available as always. We wish everyone a great end to the summer and looking forward to September. Thank you all.
Thank you.